Welcome to the deep dive. Today, we're tackling a really significant piece of research.
Yeah, it's a new report from the Bank for International Settlements, the BIS.
Right, called Defying Gravity, an empirical analysis of cross-border Bitcoin, Ether, and stablecoin flows. Quite a title.
It is, but it's backed by some serious data. We're talking 184 countries, from 2017 right up to mid-2024.
So, a really broad empirical look. Okay, let's unpack this. The headline, for me, is that cross-border crypto activity really spikes when traditional financial systems are under pressure.
Exactly. Think expensive remittances, high inflation, governments putting up capital controls.
It's like when the old financial rails get shaky, crypto kind of finds a pathway.
Precisely. It suggests that for a growing number of people, maybe crypto isn't just a speculative gamble. It's becoming a practical tool when the usual options, they just aren't working well.
Okay, so in this deep dive, we're going to explore the key insights from this BIS report.
Yeah, we need to look at the scale first. The sheer amount of crypto moving across borders is kind of mind-blowing.
Right, the volume. And then there's this fascinating shift, isn't there, from Bitcoin to stablecoins really taking the lead.
A huge shift. We'll definitely dig into that. And also why the economic models we normally use,
Yep.
the ones that explain how money moves,
Yeah.
they seem to, well, stumble a bit when you apply them to crypto. It highlights how different this really is.
And understanding the why behind it all. Is it speculation? Or is it actual, transactional use? The data gives us clues.
It does. We need to separate that out.
Yeah.
And we'll look at real-world examples, too, places like Venezuela, Nigeria, Lebanon, where things are tough economically.
See how crypto adoption plays out on the ground there.
Yeah, exactly. And stable coins, we can't ignore them. They're such a huge part of the story now.
We need to understand how they work, why they're so popular, these digital dollars, basically.
Right. And looking ahead, there's the role of AI, artificial intelligence. It's
Right.
popping up everywhere. And it's relevant here, too, for understanding and maybe even regulating these flows.
Okay, and this is where it gets really interesting for me. The idea that traditional capital controls, they might be losing their punch against crypto.
That's a major finding. It really questions how governments can manage money flows in the future.
Which leads straight into the whole regulatory challenge. How do you even govern a system that's, designed to be borderless and decentralized?
It's a massive puzzle for regulators. We'll touch on the challenges.
So ultimately, it feels like we're seeing the beginnings of a new kind of global financial infrastructure emerge.
That's the big picture. Yeah, something quite different from the status quo.
Okay, so our aim today is to give you, our listener, a clear picture of these complex dynamics and what they could mean. Let's start with the scale. How much crypto are we actually talking about moving across borders?
The numbers are really eye-opening. The report highlights a peak in 2021, get to this $2.6 trillion.
Wow. $2.6 trillion. How does that compare to, anything?
To put it in context, that was roughly 12% of all global trade in goods that year.
12%. That's huge. It's not some niche thing anymore.
Not at all. Think about this. It exceeded the entire global airline industry's revenue in 2021.
That's incredible. Trillions moving on blockchains, mostly outside the traditional banks.
And here's a key detail. Stablecoins made up half of that $2.6 trillion.
Half. So not just Bitcoin volatility chasing.
Nope. Stablecoins like Tether, USDC, these digital dollars, they've become major payment rails, especially, as you said, in economies facing instability.
That's a really significant shift, isn't it? Bitcoin got the early press, but stablecoins are showing their practical side.
Definitely. Now, the report does show a dip in 2022, down to $1.8 trillion. But that doesn't mean it's fading away.
More like a market correction, maybe? And picking up again.
Seems like it. The report suggests renewed growth. But what's really changed is the composition of those flows.
Right. Bitcoin's dominance has faded.
Dramatically. It used to be around 80% of cross-border flows. Now, it's under 25%. Stablecoins are the clear leaders now in volume.
And the reasons people are using crypto are changing too. It's not all about speculation, especially outside places like the US or UK.
Exactly. While speculation is still a factor in places like Lebanon, Nigeria, Argentina, the drivers are often very different. It's less about getting rich quick.
More about necessity.
Yeah. Basic financial survival sometimes. Protecting savings from hyperinflation, accessing money when banks limit withdrawals, just moving funds when you need to.
And it's cheaper, right? Sending money home using crypto versus traditional options.
Much cheaper in many cases.
Huh.
The report mentions the fees on traditional remittances, like Western Union. They can take a big bite, especially out of smaller amounts.
Like sending money from Dubai to Nigeria, for example.
Yeah, crypto can cut that cost down dramatically, sometimes just cents for the network fee, the gas fee.
And this cost effectiveness is creating new hotspots for crypto activity.
Absolutely. We're seeing new major crypto corridors emerge. Think Russia, Turkey, India, UAE, Vietnam, Indonesia. These are seeing massive flows, sometimes surpassing traditional financial routes.
So it's really filling a gap where the old system isn't quite cutting it for people.
That's exactly right. And you see the infrastructure growing in these places too. Exchanges, wallets, OTC desks, the whole ecosystem. A digital wallet just being the app you use to hold and send crypto.
Okay, so huge scale, stablecoins driving it, especially where traditional finance struggles. Let's dig into why the usual economic models don't quite explain this. The BIS report mentions the gravity model, right?
Yes, they tested it. The gravity model is a standard economics tool. Basically, it says trade between two countries gets bigger the larger their economies are, and smaller the further apart they are.
Makes sense. Big, close countries trade more.
And it works pretty well for physical goods, for traditional banking flows, even stock market investments.
But not for crypto.
Not really, no.
Yeah.
The BIS found that when they applied it to crypto flows, factors like distance, sharing a border, even speaking the same language, things that normally matter a lot, they had surprisingly little effect.
How little? Is there a number on that?
Yeah, the difference is quite stark. For traditional banking, flows decrease by about 0.6% for every 1% increase in distance. For crypto, the decrease is less than 0.1%.
Wow. So distance is almost irrelevant for crypto flows. That really speaks to the whole borderless idea. Finance becoming less about geography, more about networks.
Precisely. And the report talks about multilateral resistance.
Mm.
That's basically all the friction you encounter trying to send money across borders, traditionally different rules, intermediary banks, delays.
Crypto cuts through a lot of that friction.
Significantly.
Yeah.
You don't need that chain of trusted intermediaries in the same way. The blockchain handles the trust part.
So traditional banking is like these tribal kingdoms, the report calls them, with permissions and compliance rules.
That's a good description. Swift correspondent banks.
Mm.
It's complex. You need permission. Crypto, on the other hand, is largely permissionless.
All I need is an address and enough gas for the fee.
Pretty much. An address being your unique identifier on the network, and gas being the transaction fee. It's just a more open system.
And the pseudonymity factor plays a role too, doesn't it? It's not fully anonymous, but your real name isn't automatically tied to your address, like a bank account with KYCML rules.
Right. Which, raises flags for regulators about misuse, but it also allows people to move funds in high-risk places where traditional channels might be blocked or just too difficult. The gravity model wasn't built for that kind of circumvention.
And crypto networks are actually more connected globally than banking networks.
That's another key point. In 2023, the BIS found about 60% of all possible country-to-country crypto connections were active.
60% compared to banking.
Compared to only about 12% for traditional interbank connections.
Yeah.
It shows how densely interconnected the crypto world is.
Like comparing a mesh network like the internet to old point-to-point phone lines.
Good analogy. More pathways, more resilience, more connections, and analyzing this massive, complex web of transactions, that's where AI comes into the picture, even if the report doesn't dive deep into AI itself.
Because humans just can't process that much data.
Not effectively, no. AI algorithms can crunch through blockchain data, spot patterns, maybe flag suspicious activity, even try to predict future demand for stablecoins based on economic signals.
So AI could see a spike in stablecoin use between two countries and flag it as maybe a sign of economic trouble or people getting around capital controls.
Potentially, yes, in near real time.
Yeah.
It's a level of insight that's just not possible with traditional methods looking at historical data.
It feels like AI could be a game changer for actually understanding these flows, not just measuring them.
Exactly. Understanding the why and the how in much greater detail.
Mm.
So yeah, the traditional models struggle because crypto operates on this entirely different networked, borderless logic.
Yeah.
And making sense of that complexity, that increasingly points towards AI.
Okay, so we know the scale is huge, stablecoins are dominant, and old models don't fit. Let's get back to the motivations. Is it mostly speculation, or is crypto genuinely being used for, real stuff?
The BIS report suggests it's a mix, but it depends on the coin. For Bitcoin and Ether, the big ones, speculation still seems to be a major driver for cross-border flows.
How do they figure that?
Their volumes tend to go up when global market volatility increases, like when the VIX index spikes.
So more uncertainty, more Bitcoin and Ether moving around, maybe people trying to trade the swings.
That seems to be the pattern. Bitcoin especially acts a bit like a risk asset people move based on market mood. But it's a very different story with stablecoins like Tether and USDC.
Right, because their value is meant to be stable, pegged to the dollar. Less fun for speculators, maybe?
Exactly. But much more useful if you actually want to transact or send money home. Remittances. The data strongly suggests they're being used for these real-world purposes.
And didn't the report mention something about small Bitcoin transactions aligning with remittance routes?
Yes, that was fascinating. When you filter down to smaller Bitcoin transfers, say under $200 or $500, the flow patterns start looking a lot like traditional remittance corridors.
Suggesting people are using Bitcoin for smaller cross-border payments, maybe dodging those high fees we talked about.
That's the implication. Even if larger Bitcoin movements are speculative, these smaller ones hint at a practical transactional use case.
And businesses are getting in on the act with stablecoins, too.
Definitely. Small businesses, especially those trading internationally or hiring remote workers, are finding stablecoins faster and cheaper for payments. Avoids bank delays, potential freezes, currency conversion headaches.
So it really seems like there's this split emerging. Crypto as a casino with Bitcoin and Ether, and crypto as cash with stablecoins.
That's a great way to summarize it. The report points to this dichotomy, and stablecoins are clearly dominating that cash role in cross-border flows now.
Okay, the data is one thing, but the real-world examples really drive it home. What did the report say about places like Venezuela, Nigeria, Lebanon?
These are really stark case studies of crypto adoption under duress. In Venezuela, you had hyperinflation just destroying the bolivar. People turned, increasingly, to crypto, especially USDT, Tether, just for day-to-day stuff in black markets.
Using a stablecoin because the local currency was worthless. For food, medicine.
Pretty much, it became a parallel means of exchange, a way to just function when the official system broke down. Lebanon, similar story after its banking system collapsed and the currency tanked.
People lost access to their savings, right?
Yeah, exactly. So you saw people using things like MetaMask wallets and peer-to-peer exchanges to get into stablecoins like USDC, just trying to protect what little they had left outside the formal banking sector.
And Nigeria, high-tech adoption, but also a tricky FX market and that crypto ban attempt.
Right, which didn't really work, or maybe even spurred more adoption. Young people there, especially, embraced crypto, using platforms like Binance P2P to swap Naira for USDT or Bitcoin.
For what? Freelance payments? Savings.
Both. Getting paid for online work from abroad, or just trying to save in something perceived as more stable than the Naira.
So the common denominator in all these places is, well, a breakdown of trust. In the banks, in the local currency.
Absolutely. When faith in the established financial system evaporates, people don't just sit there. They actively look for alternatives, and crypto, particularly stablecoins, provides one. It fills that void.
And the report notes crypto flows shifting towards these emerging economies with shaky systems.
Yes, there's a noticeable trend of flows originating in more advanced economies and moving towards these EMEs. It underlines that this adoption isn't just about ideology. It's often driven by sheer necessity.
It's a powerful point. We talk about crypto investment, but for millions, it's becoming a lifeline.
Okay, so stablecoins are clearly central to this story, making up nearly half of all these cross-border flows. Let's just quickly revisit why they're winning.
You mentioned the dollar peg, stability, and speed.
Those are the core advantages. Stability makes them usable for payments. Speed, near instant global transfers, beats the days-long wait times of traditional banking.
And different flavors are popular in different places. Tether on Tron is big in Asia, Africa, Latin America.
Yeah, mostly because Tron transactions tend to be very fast and very cheap. Those low gas fees matter a lot when you're dealing with smaller amounts or working in lower income regions.
Whereas USDC on Ethereum is maybe seen as more regulated, more Western focused.
Generally, yes. Circle, the USDC issuer, puts a lot of emphasis on transparency and compliance, which appeals more perhaps in the US and Europe. Ethereum is also the dominant platform for DeFi.
But fundamentally, they both work by holding fiat reserves dollars, usually to back the tokens on the blockchain, right?
That's the idea. Reserves held one-to-one, supposedly allowing the stablecoin to maintain its peg and letting users redeem them back into fiat currency.
And because they live on blockchains, they can interact with smart contracts, fueling that whole DeFi explosion.
Exactly. Smart contracts, self-executing code on the blockchain enable all sorts of automated financial services, and stablecoins are often the basic building block, the unit of account, within DeFi.
Lending, borrowing, trading.
All sorts of things. And it's not just DeFi degens using them. As we said, small businesses, NGOs, importers, exporters are increasingly adopting them.
For faster, cheaper international payments, presumably.
That's a big part of it, avoiding banking delays, high fees, currency conversion issues. For NGOs, it can mean getting aid funds directly where they're needed, faster and more transparently.
It really does make you wonder, if this continues, how much do we need traditional banks for these kinds of cross-border transfers? Though there are still risks, right? Concerns about reserves, centralization.
Oh, absolutely. Transparency of reserves, the potential for censorship by issuers, regulatory uncertainty. These are very real concerns and areas of intense focus right now.
Yeah.
But the potential for stablecoins to fundamentally reshape cross-border payments is undeniable. If they become more trusted and regulated, they could become a major alternative rail.
Okay, let's pivot slightly. We mentioned AI earlier. Given the scale and complexity we're talking about, how crucial is AI becoming in just understanding, let alone managing these flows?
It's becoming essential, frankly. The sheer volume, speed, and interconnectedness of crypto transactions, it generates these enormous data sets. It's just too much for human analysts to track effectively.
So AI steps in to do what humans can't.
Pretty much. AI can perform real-time transaction tracing across blockchains, analyze complex networks of wallets, detect anomalies that might signal illicit activity, and even forecast future volumes.
Like a superpowered blockchain surveillance system.
In a way, yes, but it's more than just surveillance. Machine learning models can learn to correlate crypto activity with economic indicators, inflation, capital controls, remittance costs, political instability.
To get early warnings.
Potentially, yes. Predictive capabilities could flag emerging risks or shifts in economic sentiment much faster than traditional methods.
And companies are already using AI for this, like Chainalysis, TRM Labs.
Yes, they're well established in using AI, particularly for tracing illicit funds and ensuring compliance. But the potential for regulators is huge, too.
How so? What could regulators do with AI?
They could use it to map out these stablecoin corridors we discussed, monitor activity in DeFi protocols without needing to understand every single line of code, and identify potential systemic risks before they blow up.
Almost like building AI dashboards for financial stability, monitoring on-chain data in real time.
Exactly. Imagine a central bank seeing a sudden surge in USDT wallets in a specific region as an early indicator of falling confidence in the local currency. That's powerful, timely insight.
It shifts the conversation from just banning crypto to actually understanding why people are using it, doesn't it?
It should. Using AI to understand the drivers, maybe it's high remittance fees, maybe it's lack of banking access, maybe it's capital flight, allows for more targeted and potentially more effective policy responses than just a blanket ban.
Of course, there's always the flip side, the potential for AI to be used for excessive surveillance. But we'll leave that for another day.
Acknowledged. But the main point here is that navigating this complex, decentralized economy pretty much requires AI tools now. Without them, you're flying blind.
Okay, so AI is key. Now, one of the most provocative findings in the report was about capital controls. These government rules to stop money flooding out, or sometimes in.
Right. Capital flow management measures, CFMs, limits on exchanging currency, bans on certain investments, basically financial firewalls.
And the BIS report says crypto just walks around them.
That's the strong implication. The report finds that traditional capital controls are largely ineffective against crypto. And get this, sometimes imposing stricter controls might actually increase crypto adoption.
How does that work? If the government says you can only buy $100 of foreign currency, how does crypto help?
Because you can often buy crypto, especially stablecoins, through channels outside the formal banking system, P2P exchanges, OTC desks. Once your money is on-chain, moving it across borders is technically much simpler and bypasses those bank-based controls.
So Argentina, with its dollar restrictions, is a classic example.
Prime example. There's a huge informal market for Tether there, precisely because official access to dollars is so limited. People use crypto, often via platforms like Telegram, to get around the controls. It's a parallel system born out of necessity.
And Turkey, with a falling lira, people using crypto to hedge.
Exactly. As the lira weakens, people buy stablecoins to preserve their purchasing power. USDT effectively becomes an unofficial alternative currency for savings and maybe some transactions.
Even Russia under sanctions.
Yes. With traditional banking channels cut off by sanctions, stablecoins reportedly became a crucial tool for some individuals and businesses to make cross-border payments and stay connected to global finance, albeit outside the formal system.
So instead of stopping the flow, The controls actually push people onto these crypto rails.
It seems that way. They act as a trigger, accelerating the adoption of these parallel on-chain systems. And trying to enforce old rules on new tech is tough.
You can't exactly slap controls on a decentralized protocol easily.
Right. You can't just sanction a smart contract or subpoena an algorithm. It's a fundamental mismatch.
So citizens find this escape hatch, even if governments try to block websites or control the internet.
The decentralized nature makes it very resilient. People determined to move assets find ways.
Which brings us squarely to the regulatory dilemma. How on earth do you regulate this borderless, real-time, pseudonymous system?
It's the million-dollar question, maybe $1 trillion now. Traditional regulation relies on jurisdiction, on identifiable entities. DeFi doesn't fit neatly into those boxes.
Like that example, a DAO in Argentina interacting with a liquidity pool in Singapore via a smart contract hosted globally. Who regulates that?
Exactly. Where's the transaction happening? Who's responsible? The old rulebook just doesn't map cleanly onto this.
So current efforts focus on the edges, the on-ramps and off-ramps.
Mostly, yes. Targeting the exchanges where fiat turns into crypto, the stablecoin issuers, the banks that touch crypto, trying to control the interaction points with the traditional system.
But we're seeing P2P markets grow, direct wallet transfers, bypassing those controlled points, and even the issuers are getting more decentralized.
Which makes that control the ramp strategy harder and harder to maintain effectively. The system is designed to route around bottlenecks.
So again, maybe AI is part of the answer for regulators to see the flows, assess risks, adapt.
It has to be part of the conversation.
A-
AI could enable a shift from static entity-based rules to more dynamic, risk-weighted, flow-based supervision that actually understands on-chain activity.
There's a real sense of urgency here, isn't there? Regulators need to catch up or risk becoming, well, sidelined.
That's the danger. The gap between crypto innovation and regulatory adaptation is widening. If finance becomes increasingly unbundled and protocol-driven, regulators need new tools and approaches protocol-aware real-time, or they risk losing relevance.
Okay, so if the old models are broken, capital controls are leaky, and regulation is struggling, where's this all headed? What does Infrastructure 2.0 look like?
It looks more modular, I think. More global, inherently digital, and much more automated than today's systems, which are often monolithic, geographically bound, and slow.
Give me some examples. What kind of tech emerges?
Think smart wallets with AI baked in, automatically finding the cheapest way to send your money across chains. Microinsurance on stablecoin payments, triggered automatically by code.
And on the back end, for governments.
Real-time AI dashboards for finance ministries, showing capital flows and wallet behavior almost instantly, not based on last quarter's statistics.
And you mentioned stablecoin zones.
Yeah. Imagine economic areas, maybe online communities or specific trade networks, where one or two stablecoins become the de facto currency, regardless of national borders. Token-based economies.
With AI managing the plumbing,
Yeah.
liquidity between chains, forecasting volumes.
Absolutely. AI managing cross-chain bridges, predicting demand spikes, dynamically adjusting fees, maybe even AI agents handling FX hedging for individuals, or DAOs negotiating trade deals algorithmically. Borderless credit scores based on your on-chain history.
This sounds incredibly disruptive for the old guard. SWIFT, Western Union, Visa.
They'll need to adapt massively, integrate blockchain, leverage AI, find new value propositions, or risk being bypassed by more efficient, decentralized alternatives.
So the key ingredients for this future are trustless systems via blockchain and intelligent automation via AI.
That seems to be the direction of travel. The huge question hanging over it all, as the report subtly asks, is who builds this?
Yeah.
Who governs it? Decentralized communities? Tech giants? Governments adapting?
I don't know yet.
No, that's playing out right now.
Okay, this has been a really comprehensive look at this BIS report and its implications. Let's try and boil down the key takeaways for everyone listening.
Sure. First, crypto cross-border flows are significant. We're talking trillions. It's a real economic force, not just speculation anymore.
Second, stablecoins are now the dominant players in these flows. They're acting as payment rails, especially where traditional finance is weak or expensive.
Third, traditional economic models based on distance don't really work for crypto. It's a network effect, not geography. And traditional capital controls, they're proving pretty leaky against this tech.
Fourth, regulators are facing a huge challenge. The old rules don't fit well, and they need new tools, potentially involving AI, to keep up with this borderless, fast-moving space.
And finally, all this points towards the emergence of a new kind of global financial infrastructure. It's still early days, but it looks like it will be more automated, more AI-driven, and built on blockchain rails.
So, the final thought for you, the listener, is to consider what this shift towards decentralized, automated finance really means. What are the implications for financial sovereignty, for your own economic freedom, maybe even for global stability?
And particularly if you're listening from a place grappling with inflation or financial restrictions, these alternative networks might seem less abstract and more like a present-day reality or future possibility.
It's definitely an evolution that's happening right now, under the surface perhaps, but with potentially huge consequences. It's certainly worth keeping a close eye on. Thanks for diving deep with us today.